Hello, and welcome to another edition of Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. On July 4th of this year, President Trump signed into law the One Big Beautiful Bill Act, or we're going to call OBBA for short, which brought with it some new opportunities for investors. So for this edition of the Symmetry Spotlight, I'm going to break down some of the key provisions that could impact you with some of these new laws. One of the main goals of the OBBA was to extend some of the tax provisions from the 2017 Tax Cuts and Jobs Act, which were set to expire at the end of 2025. Many of us could have seen an impact on our tax bills next year should these have provisions expired for us. For example, our current income tax brackets would have reverted back to the higher brackets we saw previous to 2017. Also, the standard tax deduction, which almost doubled back in 2017, would have been cut in half starting next year, which would have possibly left many of us with a much higher tax bill. But with the passing of the One Big Beautiful Bill Act, these lower tax brackets and these higher standard deductions, these are going to continue on for taxpayers. Moving forward, many of the temporary provisions from the Tax Cuts and Jobs Act from 2017 were now made permanent. As I mentioned, one of them being the higher standard deduction. So for 2025, the standard deduction for a single taxpayer is $15,750, while married filing jointly couples are going to get a standard deduction of $31,500. Both of those are set to be adjusted upwards with inflation for future. The new act also introduced an additional tax deduction of $6,000 per person for taxpayers over 65 years old. So a single tax filer over 65 could use their $15,750 standard deduction and potentially qualify for additional $6,000 on top of that. Married filing jointly taxpayers could qualify for an additional $12,000 deduction on top of their standard deduction of $31,500. You'll notice I keep saying you could qualify for this additional deduction because it does phase out based on your income levels. For single filers, the $6,000 additional deduction starts to get reduced if your income is over $65,000, and the same rule applies for married filing jointly taxpayers whose combined income is over $150,000. Some of the other new provisions of the One Big Beautiful Bill Act, they're a bit more niche, but they're great to be aware of. So for example, if you work in a service job and you receive tips, there are no taxes on tips up to $25,000 per year. Or if you regularly work overtime hours, you can now expect no taxes on those overtime hours up to $12,500 per year. However, both of those do have some income limitations that could kick in and reduce those benefits for you. Another new provision can put you in a position where you might be able to deduct the interest that you pay on a car loan on a new car purchased between 2025 and 2028. Both the vehicle itself and the taxpayer have to meet a certain criteria to be able to use this deduction. So you'll definitely want to check with your CPA and see if your new vehicle could qualify for this additional tax deduction. There were also some adjustments made for taxpayers who make charitable contributions that could allow you to deduct those contributions again. Previously, only taxpayers who itemize on their taxes could deduct charitable donations. But now for folks who do not itemize, you could deduct up to $1,000 of charitable donations if you're single or $2,000 if you're married. Those of you who still itemize can still deduct your charitable donations within the limits that are provided by the IRS. For those of you with dependent children, the child tax credit was increased to $2,200 per child if you are under the income limits and qualify. They also established Trump accounts, which are basically an IRA account that can be established for a child born between 2025 and 2028. The proposed accounts are funded initially with $1,000 from the government, but they can be contributed to by parents and others as well. There are lots of rules with these accounts, and they actually aren't going to be available until around July of 2026. But it could be something to keep on your radar if you currently have a newborn or plan to have one in the future. On top of all those, there were even more changes to the tax law that could affect taxpayers. There are also some new options for businesses, and there were some changes to the estate tax rules and gifting strategies that could apply to higher net worth families. For today, I just wanted to highlight some of the ones that could impact the majority of taxpayers. I would really strongly encourage you to make sure you speak with your CPA or your accountant to see, is there anything you should be doing differently now to make sure you're taking advantage of these new tax strategies? If you have any questions on any of this information, or you want to talk more about how some of these new changes apply to your situation, please don't hesitate to give me a call. Otherwise, I appreciate your watching, and I look forward to talking with you again soon.